Hi, my name is Heather Orillion, and for my Finance 381 class, we had to analyze three companies and then decide which company we would give a short-term loan to, a long-term loan to, and which company we would consider buying. I chose ExxonMobil, an oil and gas corporation, Procter & Gamble, a consumer goods company, and Coca-Cola, a beverage corporation and manufacturer. The first question we needed to answer was which company we would consider giving a short-term loan to. For this question, I used the quick, cash, and current ratio. The quick ratio measures the ability of the company to pay its current liabilities. For each company, I looked at its quick ratio for the past 5 years. For Coca-Cola, it was 0.61, 0.58, 0.59, 0.73, and 0.67. For Procter & Gamble, it was 0.12, 0.10, 0.18, 0.20, and 0.32. And for ExxonMobil, it was 0.12, 0.16, 0.15, 0.06, and 0.07. Then I looked at the cash ratio for each company. The cash ratio is the amount of cash a company has over current liabilities. I analyzed each company over the past 5 years. For Coca-Cola, it was 0.61, 0.58, 0.59, 0.73, and 0.67. For Procter & Gamble, it was 0.12, 0.10, 0.18, 0.20, and 0.32. And for ExxonMobil, it was 0.12, 0.16, 0.15, 0.06, and 0.07. The last ratio I looked at was the current ratio. The current ratio is used to examine the liquidity of the company and its ability to pay short-term liabilities with its short-term assets. I looked at the current ratio for each company over the past 5 years. For Coca-Cola, it was 1.17, 1.05, 1.09, 1.13, and 1.02. For Procter & Gamble, it was 0.77, 0.80, 0.88, 0.80, and 0.94. And for ExxonMobil, it was 0.94, 0.94, 1.01, 0.83, and 0.82. For current ratios, it is expected for companies' current ratios to be at least 1. When the current ratio is below 1, it means that the net working capital is negative. So based upon the information from Bloomberg, I would give a short-term loan to Coca-Cola. The next question we had to answer was who would we give a long-term loan to. For long-term loans, I looked at the leverage ratios, which are equity multiplier and times interest earned. Long-term ratios are intended to show a firm's long-run ability to meet its obligations. The equity multiplier is a financial leverage ratio that measures the amount of a firm's assets that are financed by its shareholders by comparing total assets with total shareholders' equity. For Coca-Cola, it was 2.18, 2.44, 2.58, 2.67, and 2.87. For Procter & Gamble, it was 2.16, 2.11, 2.1, 2.1, and 2.1. And for ExxonMobil, it was 2.08, 2.1, 2.08, 2, and 2. The next thing I looked at to decide which company I would give a long-term loan to is times interest earned. This ratio measures how well a company has its interest obligations covered. A high value of times interest earned is favorable, meaning greater ability of a business to repay its interest and debt. For Coca-Cola, it was 11.53, 24.4, 27.15, 22.09, and 20.1. For Procter & Gamble, it was 16.94, 18.65, 17.28, 21.48, and 20.76. And for ExxonMobil, it was 154.91, 219.04, 152.54, 4,477.89, and 119.17. The more leverage, the more risk. With that being said, I would consider giving Procter & Gamble and ExxonMobil a long-term loan. The last question we had to answer was which company we would consider buying. For this question, I looked at return on equity, return on assets, and price-earnings ratio. Return on equity measures how well stockholders fared during the year. I analyzed three companies' ROE, and Coca-Cola's was 42.5, 27.61, 28, 26.03, and 22.16. Procter & Gamble's was 20.58, 18.32, 16.32, 17.14, and 16.91. And for ExxonMobil, it was 23.67, 27.26, 28.03, 19.17, and 18.67. Next, I looked at return on assets. Return on assets is a measure of profit per dollar of assets. I looked at the ROA for each company, and for Coca-Cola, it was 19.51, 11.31, 10.86, 9.74, and 7.8. For Procter & Gamble, it was 9.68, 8.85, 7.95, 8.33, and 8.21. And for ExxonMobil, it was 11.37, 12.96, 13.5, 9.57, and 9.34. The last thing I looked at was the price-earnings ratio. The price-earnings ratio measures how much investors are willing to pay per dollar of current earnings. We want the price-earnings ratio to be high because that means the marketplace likes it and that the company has significant chance for future growth. For Coca-Cola, it was 19.56, 18.23, 17.72, 19.83, and 20.63. For Procter & Gamble, it was 16.34, 16.43, 15.86, 19.11, and 18.99. And for ExxonMobil, it was 11.67, 10.07, 9.66, 13.73, and 12.27. Based on ROA, ROE, and price-earnings ratio, it's hard to say which company I would invest in. All three companies decreased within the past 5 years. Coca-Cola has a higher price-earnings ratio than Procter & Gamble and ExxonMobil, but its ROA and ROE have fallen the past 5 years. Since Coca-Cola has a high price-earnings ratio, it suggests that this company has the greatest chance to grow in the future. Based upon everything, I would consider buying the Coca-Cola company. After researching Coca-Cola, Procter & Gamble, and ExxonMobil using the Bloomberg Lab, I determined that I would give a short-term loan to Coca-Cola, the long-term loan to Procter & Gamble or ExxonMobil, and I would consider buying Coca-Cola. This has been my financial analysis of Coca-Cola, Procter & Gamble, and ExxonMobil. Thank you.